Right. Hey guys. Hope everyone is doing well. Thanks for tuning in. So I got a potential trade setup that I'm actually looking at to potentially short. But I just want to make it clear that I'm not advising anyone to take any trades. This is entirely you know, if you choose to follow it, it's entirely up to you. I don't hold any responsibility there. Just, make sure that you're obviously trading with good risk management, okay? Um, but yeah, so this is just my particular trade that I'm thinking of looking to trade, okay, myself. And yeah, we'll see, right? So the pound US dollar, I think, has some good potential here. I think it's probably my A plus setup that I'm looking at right now. So obviously, as you guys know, we look at the fundamentals first. We always base our trades here at entry point with the fundamentals, right? So what we are trying to look for is macro shifts, really to keep it short and simple. We want to see the macros shift. With that, then that guides central bank, I guess you can say tone or their guidance, and with that also affects the market. The next thing that we're also going to look at is the rate expectations, whether we're easing or we're tightening. What is the market pricing in, right? Because what you'll notice is if you've been trading for a while is that markets trade expectations, right? A lot of the times when things are priced in, you're not really going to see, either the move is very substantial, it's very neutral, or there's actually a sell, or whatever, right? It's not really going to do much when markets have already been expecting it, right? You can see that very clearly in the yen, right? Everyone has expected, at least pretty much everyone literally expected a hike of 1%, and that really didn't do much to the yen. Okay. So all right, let's look at the fundamentals first. So we'll start with the divergence heat map. A really, really cool concept here where you can essentially see all of the currencies in what they call, like, divergence, literally, in terms of the currencies. Um, we can see strength or weaknesses. So this gives a really quick view of everything. So the pound US dollar here has obviously a negative reading. We can see that the pound has a 44 bearish score, while the US dollar has a bullish score of 58. So that when you find the difference, that's obviously minus 14 points, right? So there's clear bearishness on the pound, weighing to the pound. And we can also see that here in the currency chart, right? It kind of puts everything into perspective from COT, retail, CB's, central bank stance, bank research fundamentals, seasonality, to basically get this bias, right? So, um, obviously, for the most part, the bullish score is really coming from the fact that obviously fundamental wise, the US dollar has been relatively stable. I don't think we have been getting very much weakness coming into the US dollar, right? Growth is still, I mean, it's definitely weakening, but it's not, you know, uh, deflationary. It's not in a sense of a dire weakness. It's in a sense of like, okay, growth is weakening, but overall, in terms of the US dollar is concerned, is still relatively stable. We're getting a lot of growth coming in from AI spendings, and a lot of stocks have been actually outperforming in terms of their earnings. Obviously, we see recently a global equity sell-off, which I talked a little bit about that yesterday. Um, but really that is all kind of coming to the fact that a lot of these stocks are very stretched, especially these AI names, and we're getting a little bit more fear coming in with the Fed hawkish repricing that we got last week on the FOMC statement, right? During the Fed meeting, right? Obviously, we know that the Fed chairman Walsh is extremely hawkish, right? Their focus is on combating inflation. Traders are pricing in at least a hike by September. The committee, as well, and the Fed, 50% of them are actually also requesting in the dot plot to actually have at least one hike by end of the year, right? So I think for now, this is more of a hold for rates, kind of, or I guess you can say hold rates for longer path for the dollar. And I think by 2027, if the geopolitics side ends up really truly easing, obviously it's already easing. We see the oil, or crude oil, actually just been selling off really nicely for the past, I guess, week or so. Um, and or a little bit more than that, and we see a clear deal kind of and positive deal with between Iran and the US. I think for the most part, the opening of the Strait of Hormuz is more or less there already. We can probably see that in the situation meter real quick. Let's take a look at that. Yeah, so okay, right now it's a little bit restricted, I guess. It's I don't know. It was. I believe I did edit. I have a picture here of it actually. That's funny. Of it actually being open. So I think they just re-updated the information. Let me just show you so you guys don't think I'm going crazy here. But this was the image. Yeah, you can see open 100%. So I don't know. I mean, I guess it was re-updated. But okay, fine. I mean, but for the most part, I believe the worst it was at was actually 5 million barrels per day, right? So it was way more restricted. But I guess there's still some restriction in the Strait of Hormuz. So we'll see. All right, we'll see. Um, so all right, looking at the okay, the US dollar is done. So let's talk about the pound right now. So we can see a pound is getting a really bearish score. So let's dive deeper into that. So we'll start with the overall narrative, then we'll move on to monetary policy, etc., etc. I'm also going to be talking a little bit more about the bank or the rate expectations that the market is pricing in. So obviously, okay, so narrative wise, Starmer resignation imminent, right? So we got if you guys have been keeping up with the UK politics, Starmer is actually basically resigned fully. Like he's already spoke about. I believe he made a speech of his confirmation on the resignation yesterday. Burnham is probably gonna come in and take the lead here. The Bank of England easing bias cemented despite sticky core CPI at 3.2% on 19 June, right? So we'll talk a little bit about that. We'll definitely see that in the macro data. Labor market collapse and employment is actually weaker, which validates the dovish July path, right? So I think for the most part, just from that narrative, we can already see that there is obviously a less hawkish stance now. We could probably see the Bank of England becoming a little bit more dovish in the next meeting in July. For now, according to the software here, we can see that it actually has a holding restriction still by the central bank, but we probably, the markets obviously trade based on expectations, right? Trades based on forecasts, and I think this will probably change, but we'll see. We'll see. So, monetary policy wise, we're still at 3.75%. Accelerating labor market weakness embeds easing possibly into the 30th of July meeting. So you can already see the tone here, guys, on this report. All right, that one's just a repetition of what we talked about. CPI is still at 3.2%. Employment fell. Okay, services contracted. Burnham by-election victory on 23rd June raises Starmer replacement odds above 90%. Okay, that's that. Leadership transition deadline 27 September. Okay, so that's more of the politics there. So that one has some risk there for sure. I think from what I've been hearing from a lot of portfolio managers on Bloomberg, etc., they've been talking a little bit about the fact that yields could be a little bit more elevated with this political risk above. I think for the most part, the market is looking at it positively though, because we're seeing the FTSE still pertaining to the FTSE 100. It's still looking quite, I guess you can say it's not strong, right? For the most part, it's been consolidating within this geopolitical problem with the high inflation issue, with this restrictive stance by the central bank. So it didn't really break out to new highs like the other stocks. But if we see oil start to, ease, right, cost starts to go down, we see inflation sort of weakening. We see a dovish stance with the Bank of England. The FTSE is definitely going to run. Right? I mean, I don't want to say definitely, but in terms of all of the criterias, it makes more sense for the FTSE to run. Okay, so I hope that makes sense. But I want to talk a little bit of the fact that this right here, right, might not hold because of the fact that the markets are actually reacting positively with the new potential leadership. I mean, not potential at this point, but I'm just probably going to take it. everyone is talking about the fact that bond yields might actually be still a little bit more elevated. There's still be a little bit more pressure because of the political risk, but I feel like that might be already priced in, and I also think that that might also be gone already, right? So, Burnham spending platform by end summer will test fiscal space, a given 3.5% plus deficit. Okay, anyways. All right, let's take a look at the macro matrix here. So GDP, really soft here, minus negative actually, so that's not really good. Manufacturing PMI also came in softer than expected. Services came in softer than expected. We're now below the 50 threshold. Retail sales did come in positive, so this was actually a really huge surprise. CPI came in softer than expected, obviously still elevated compared to prior data. But from expectation wise, we did come in a little bit soft. PPI also came in soft marginally, but still above prior, right? So obviously inflation, I think here is still elevated, right? So I wouldn't confirm that the Bank of England would definitely necessarily be dovish in the next meeting. I think we need to see a little bit more data come in for the inflation side. But when we look at the growth aspect, we definitely see some contraction. Okay. Unemployment, obviously, I mean, it just very marginally improved as well. So inflation's a problem, growth is weak. Could that trickle down to weaker inflation in the next few readings? Possibly. But what we can see here is that there's obviously a little bit more weakness in the growth side. Okay. Yeah, this one is just the forward path for the central bank. I mean, according to this, they're looking to hold. It's expected to hold, but there's another indicator that I use, which I'll talk a little bit about that later on. COT positioning, heavy short crowding, neutral signal. So there is a lot of shorts here that can create some squeeze in the market. So we'll see. We can see that for the most part, as of the recent COT reports, we've been getting a really bearish reading overall. I'll be really interested to also see because this one is the leverage funds, right? So these are more short-term positions. I do want to see the longer-term positions here. We can see US dollars on the COT report on the longer-term positioning is super bullish, right? With a net percent change of 12%. The pound is getting a negative 2.37%. So you can see institutions have also been sort of pushing longer term to medium to longer term institution positioning has also been very, very bearish on the pound. Okay. So that's for COT positioning. Seasonality as well, I guess you can say this month has been more negative, and we can definitely see that in a lot of the names recently. And yeah, so but I don't really look too much into the seasonality side, right? So anyways, that's what's been going on so far. We can take a look at what else here. I think that's about it for the most part, right? We've covered most of the reasons why we definitely see some bearishness from the pound, why it makes sense for the for this score. The US dollar still being very hawkish. We can see institutional positioning also weak on the pound. Right, we can probably take a look at the COT positioning on the dollar. We can see we actually got a little bit more of a switch here. In terms of the difference between long and shorts, we actually got a plus 12K. So there's obviously a little bit more longs stepping into the market here and for the dollar. Right. Okay, so that's that. Now I would like to talk a little bit about the chart now. So like I said, I do believe this wouldn't be happening right now. I think this will probably happen next week for a potential setup, because I've already been looking at this setup for quite a bit of time now, and we've unfortunately not got into our area of interest. This would be in a very clean area because we have actually some support here that actually can act as resistance. Now, we'll see, right? If let's say we start to trickle down even more, then I'll probably shift my entry criteria lower. Right, so I would like to short pullbacks, and what I'll usually do is I'll use the Fibonacci tool. So if let's say we're in this position, then I'll probably put the Fibonacci tool this way, and then I'll look for shorts. within our area, right? We can also see very nicely here on the 4-hour that the moving averages are confirming bearish 200 MA above the 150 and the 20, obviously. So very, very clean, very, very clean setup here. Obviously, if we take a look at a longer term time frame, we definitely still see a little bit more of a bullish trend on the weekly. But if you look at this candle, it does look like we're primed to take out this low. So I do feel like we're probably going to get some sort of pullback once this low goes. We still have some support here. So with that, I'm going to short pops, right? That's what I'm going to be doing. So obviously, that definitely look from a longer term standpoint, it looks like a start of a potential shift, which can always be very risky. But when you have the fundamentals aligning with the setup, then we want to follow the macro. Okay, we don't just want to trade the chart. We follow the macro, then the chart is there to give us an idea of where we can enter. All right, so I hope that makes sense. So the pound US dollar is something definitely very, very key here for a short. And another thing that I would like to talk a little bit about, I found this really cool indicator that basically plots all of the central bank what you call it, the central banks, it displays the central bank whether it's tightening or easing based on expectations. Okay, and if we take a look at the Bank of England here, very, very cool indicator. Unfortunately, this is not open source. I was trying to find the open source, but yeah, it's all good. Totally understand. But very, very clean setup here in terms of the expectation. So based on this indicator, we obviously see that when the expectation is actually rising, according to the indicator on how they programmed it, it's actually would indicate easing, right? So that means markets are starting to ease in terms of the rate hike, right? Less of them are actually putting in rate hikes. The probability of that is starting to reduce a little bit. And so we actually see that. So when we see easing in the expectation of hikes by market consensus, this can actually be very, very bearish for the pound. And that's literally what we've been seeing so far. All right, as we see that markets obviously move on central bank rates, okay, and expectations specifically. And we can see that when we've been actually trending higher, the pound has actually been trending lower, and that also kind of coincides with the fact that the US dollar has been super bullish and hawkish as well. Right, so a very, very interesting indicator here. So we can actually see an easing coming in on the expectations. So this kind of aligns with the fact that this could be a very, very good shot, right? Because when you ease expectations, less and less people are expecting rate hikes, and they're taking a little bit more of maybe a holding too dovish stance. That can definitely put more pressure on the pound, and coupled with the contraction of the macro data, that also can put a lot of pressure on the pound, right? If we take a look at the yield market, we can see that the pound has been trending lower, right, as compared to the dollar. So the dollar would be this blue line here. We can see the dollar has been trending higher. We can look at the pound, or the pound yield market has actually been trending down, right? So it looks like it's primed to potentially take out this low, which would be the 4.13 to 4.12 area. And so yeah, we're just seeing a little bit more weakness. I don't really see any spikes, right? Even with the recent political change, it doesn't seem like the bond market is really trying to increase any sort of potential hike there, or have a little bit more risk where they want to position themselves for higher risk premium. It just doesn't seem like we're getting that. Okay, so that also is very interesting to take note. And like I said as well, with the, as you can see, the WTI being extremely weak here, been selling off recently. With that as well, I think that easing can definitely help with the pound weakness too. Okay, so I hope this makes sense. Definitely give a like, support the channel, guys. We're trying to be more consistent with our postings. We do have a group potentially coming up as well. So those who are interested, if you have stayed long enough to watch this video, good on you guys. There's a potential group coming in probably in July, maybe early August. So just keep an eye on that, because we're going to be pushing out that group very soon. It's completely free, by the way, where it'll be a lot easier for me to share a lot of this content, maybe do some pre-market stuff, right, every week and things like that for you guys. And so yeah, Cheers.